Hello and welcome. Today, we are diving into a really fascinating corner of the accounting world. How do companies actually account for paying people? Not with cold, hard cash, but with a piece of the company itself. It's all governed by a standard called IFRS 2, and trust me, it completely changes how we see a company's real expenses. And yeah, that's really the big question, isn't it? When a company gives an employee stock options, it's not cash out the door today. It's a promise of future value. But that promise has a very real cost. So how on earth do you put a price on that promise and get it onto the books? Well, that's exactly what we're going to figure out. All right, here's how we're going to break it all down. We'll start with the absolute basics, then get into the two main flavors these plans come in. After that, we'll see how the accounting works for each, cover what happens when companies change the rules, and finally, tie it all together with why this stuff is so crucial for understanding what's really going on inside a business. Okay, first things first. What exactly are we even talking about when we say share-based payment? It's a concept that honestly revolutionized how we think about compensation. So, that official definition sounds super technical, right? But here's the deal. It's broader than you might think. This isn't just about paying your CEO with stock options. It could be giving shares to a supplier in exchange for parts, or to a consultant for their brilliant advice. Basically, anytime a company pays for something with its own stock or with cash that's tied to its stock price, IFRS 2 kicks in. So why do we even need a whole standard for this? Well, believe it or not, before IFRS 2, a company could hand out millions of dollars in stock options, and that huge compensation cost would be completely invisible on the income statement. It was a massive blind spot. This standard was created to stop that, to make sure this very real cost of doing business actually gets reported. Now, to really get a grip on IFRS 2, you have to understand one critical distinction right from the get-go. Think of it like a fork in the road. Every single share-based payment goes down one of two paths, and the path it takes determines, well, everything that follows. So here are our two paths. On one side, you've got equity settled. This is where the company gives out an actual piece of the pie, shares or options to buy shares. It hits the equity section of the balance sheet, and here's the key. Its value is measured once, on the day it's granted, and then it's fixed. On the other side, we have cash settled. Here, the company promises cash, but the payout is linked to its share price. This creates a liability, a debt, that has to be revalued every single reporting period until it's finally paid out. All right, let's walk down that first path, which is by far the most common one you'll see, the equity settled transaction. If you remember just one thing about equity settled awards, make it this. You figure out the fair value on the day the award is granted, and then you lock it in. That's the cost. It doesn't change. Not even if the company's stock price later skyrockets to the moon or, tanks. The whole process is actually pretty logical. First, you calculate that fair value on day one. Second, you don't just dump that entire cost onto the books right away. You spread it out over what's called the vesting period, which is just the fancy term for the time an employee has to stick around to actually earn the award. And third, you have to be realistic and adjust for things like people leaving the company. This little sentence from the standard is absolutely crucial. What it means is you only expense the awards you actually think people will earn. So if you grant options to 100 people, but you expect 10 of them to leave before they vest, you only book the expense for the 90 who are likely to stay. You'll tweak that estimate over time, but here's the thing you never adjust for: changes in the stock price. Okay. Time to switch gears and look at the other side of the coin, cash-settled plans. This is where the company is on the hook for a cash payment, but the amount depends on how its stock does. Think of something like a share appreciation right, where an employee gets a cash bonus for how much the stock price has gone up. So remember how we said equity settled was all about lock it in? Well, cash settled is the complete opposite. Because the company owes actual cash, that liability has to be updated to its current fair value at every single balance sheet date. It's a moving target. If the share price goes up, the liability gets bigger, and the company has to recognize more expense. It's a much more volatile way to do things. Let's just paint a quick picture here. Imagine at the end of year one, the liability is worth $100,000. But then, in year two, the company has a fantastic year, and its stock price soars. Now, that liability has to be remeasured to, let's say, $150,000. That extra 50 grand? Yep, that hits the income statement as more expense for year two. This constant reevaluation is the defining feature here. And here's where it all ties up perfectly in the end. Unlike the equity route, where the expense is kind of a fixed historical number, with cash-settled plans, the total cumulative expense you recognize over the years will match to the penny the final amount of cash that actually walks out the door. It makes perfect sense when you think about it. So companies are people too, right? They change their minds. And sometimes, especially if a stock price has fallen, a company might tweak its share plan to keep its key employees motivated and happy. As an investor, seeing this can be a real signal, and IFRS 2 has specific rules for how to handle it. This is a classic move. Let's say an employee has options to buy stock at $20, but the stock is now trading at $12. Those options are worthless. They're underwater. So the company reprices them, lowering the exercise price to $15 to make them valuable again. IFRS 2 says, hey, if you make the award more valuable, you have to account for that extra value. In this case, the fair value jumped from $5 to $8. That $3 difference is an extra or incremental expense the company now has to recognize. So after all these rules, grant dates, vesting periods, liabilities, modifications, let's zoom out. What's the big picture? Why does any of this really truly matter? It all boils down to one simple, powerful word: transparency. This standard drags the real cost of this type of compensation out of the shadows and puts it right onto the financial statements for everyone to see. It lets us, as investors and analysts, see the full picture and actually compare different companies on a true apples-to-apples basis. And a huge piece of that transparency comes from the disclosures. Seriously, the real story is often buried in the notes to the financial statements. Companies have to lay out all the details of their plans, the assumptions they used for their calculations, and the total hit to their bottom line. If you really want to understand a company, this is where you dig in. Which leaves us with one final thought. Now that you know what to look for, the kinds of plans they're using, the total expense they're booking, whether they're modifying their plans, could you open up an annual report, flip to that share-based payment note, and get a much better read on that company's health and its strategy? The answer is a resounding yes. And that right there is the power of knowing your way around the standards.